Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today's Friday. It's May 27th. It's actually my dad's birthday. My parents were born 1 year, 1 month, and 1 day apart. Isn't that funny? But it's very easy to keep track of their birthdays that way. Anyhow, happy birthday, Dad. It's 7:57. The market's going to open up in about an hour and 33 minutes to be specific with you. And as you could see here, we're just kind of mixed on the Dow, going from negative to positive, not much upside or downside, which is okay. I'd rather see that than see the Dow open up 400 points and then close down 200 points. And the NASDAQ is fairly calm as well. One of the things that I want to focus on right now, I want to show you this, and I want to try using a different type of chart, really, is volatility. Notice volatility is coming down. This is a positive sign, and the VIX can go below 25. There's a good chance we're going to get a nice rally. I think there's a good chance we'll hit 25, maybe even today if the market rallies. But again, I don't know if we're going to go below that level. We do have some puts on the VIX, full disclosure. So if we do go below 25, we'll be in the money pretty good. Those options don't expire for a while. And I like how the VIX is moving, and I like the fact how it peaked out about a week and a half before the market fully corrected to the downside. Now, we have a big report today. It's the personal income and outlays report. I'm not really concerned about personal income. That's been kind of steady, if you will, at least. I mean, it hasn't been amazing, but it's been steady. Personal consumption expenditures, because remember, retail sales data has been pretty good, and the numbers have been coming out fairly better than expected on a lot of retail stocks. Also, we're finding out that a lot of the issues that we saw with Target and Walmart were not because of people's consumer spending. It was because of the supply chain. The stores didn't have the type of supplies people wanted. People didn't want to buy umbrella chairs. So that played into the mix too. So I'm really curious how the expenditures is going to be. Previous number was 1.1%. Consensus is 0.7. If it can go a little higher, maybe 0.8 or 0.9, that would be a really good sign. If not, that would be a bearish sign, and then the Fed would come and say, we told you so. So this number is very important, more important in my opinion than the income. So keep your eye on the expenditure. That's what most traders right now, professional traders, are focused on. Another major focus that I've been, and again, everything I've been telling you about today, I've kind of been talking about for quite some time. The bond market. The bond market, folks, it's not going lower. It's moving sideways. That's another stabilized view, or a view that the long bond has had it, and it doesn't want to increase, which means the bond market, remember, bond market and interest rates are completely inverse. This is going to start doing the opposite, and it already is. There's a good chance we'll get a little mini rally, and if we will, we're going to sell this because it will come down. But I want to see if the bond market can assimilate interest rates actually staying stable or going lower versus going higher. But this is the first sign we've seen that the long bond is saying, the hell with this inflationary pressure. We've had enough. And that may cause the Fed to pause, because that's what the market's doing. The market's pausing after seeing this huge slide off. And remember, this is what triggers the tech sell-off, and this is what's causing them right now to rally. So this is very positive in the market. Don't know how long it's going to last, but this is telling us right now that the pressure we're seeing from the Fed to raise rates, the market is not assimilating any more of it, at least for now in the long term. And that's very important. Now let's talk a little bit about global economy. Shares of Alibaba and Baidu surged after they reported better than expected results, easing some concerns about the negative impact from restrictions to curb COVID infections. Both shares continue to rise. Now, Alibaba and Baidu, what were the first stocks to really take off to the downside? Chinese stocks, they're starting to come up. Russell 2000, it's starting to come up. Communication services starting to come up. Are you seeing a pattern here? The key is the stocks that sold off first are the stocks that are coming up. I was actually talking to Jeff and Lance yesterday about Western Digital and how it was one of the first stocks to come off, and now it's like the third or fourth strongest stock in the NASDAQ 100. They're focused on memory storage, but now not personal computers, but REITs and companies that have storage facilities. So like REITs that store digital data and things of such nature. So that doesn't grow when there's a recession. That grows when there's more impact of tech. So again, there's a lot of mixed data on the table. Gauging Japanese economy will be in investors' mind as data, manufacturing, housing, and employment for April are set to be released next week. So watch that market. And remember, we're short Sony, and Sony is an ADR, which means it actually trades here, but it's a Japanese stock, so it's based on based on the yen and so forth. Moody's investors lowered the 2022 projections for G20 economies to 3.1%, down from 5.9%. But again, that's priced into the market. The latest forecast is half a percentage point lower than the 3.6 growth estimated in March. So 3.1 versus 3.6, that's what's been baking into the market. Slowing economic activity in China from nation zero COVID policy is dampening growth. Not a big surprise. U.S. retailers closely watched, investors looking for more details on how much pain inflation is inflicting on companies and consumers. That's why it's important today to see what the consumption expenditure rate is, actually, speaking of that. So inflation is at a 4-decade high, and I believe it might have already peaked based on the bond market, and businesses have been raising prices on everything from food to clothes to offset the higher cost. Consumers have been resilient about spending, but the pressure from inflation remains persistent and could be prompting a pullback or a shift in spending from more expensive things to necessities. Not sure. Nordstrom's came out with some good numbers. Again, the number we want to look for consumption expenditures, the goal is 0.7. If it can go higher, that's really, really good for the retail sector. And again, the bond market is rocking and rolling, and this is relieving some pressure from stocks. Now, looking at stocks, we do want to look at stocks, don't we? Looking at the S&P, let me give you some new levels. So the S&P is ready to break out to the upside. If we can break above the let's see here, what's the high on this bar? 408.50. If we can go to the 409 level, which would be like right here, there's a good chance we're going to hit the 429 level. But we got to hit the 409 level first. So 409 on the SPY. On the QQQ, we got a little more to go. That level is 307. Write it down. It's very important. On the Dow, that number, and I like how the Dow's looking. It looks like it's almost there. On the Dow, that number is 32,800. Yeah, 32,800 or 328, but 32,800 on the Dow. If we can pass that level, there's a good chance we'll hit 34,000. I'm not kidding. I'm serious. There's a really, really good chance. So 32,800 going to 34,000 or 340, depending. I'm just looking at the diamond. It doesn't have a line. And the Russell, let's look at the Russell too while we're at it. Yeah, the Russell is already, looks like it already passed that level by a hair. Let's take a look at a 3-month. Yeah, it has. See that? So the Russell, the next level on the Russell is 193, 194. And I like the Russell and I like the small caps right now. But I'm telling you right now, being bearish right now is not the best idea. And that's why we're looking at the put to call ratio. And look at how long it's been. Look at how long we've been. I mean, look at this thing. We've been up around this territory now forever. So till we get down here, I'm going to remain bullish. Once we get down here, I'll start getting bearish. But this is still a market that's been really suppressed by the puts and needs to go higher. As far as the sectors, we've got energies and utilities. They're way above everybody else. Again, communication services is here. And once we go here, it's again almost at the second place. It's almost at the bullish level. It's right in between. So this is very important. If we can overcome industrial and financial with communications, we may be seeing a lot more bullish action because there's a lot of FANG market cap in that index. Now, for next week we're going to have a lot of data. The market is still looking bullish. And all the sectors, let me just show you all the sectors. Energy looks like it may be topping out in the short term and coming back for a pullback. Utilities may be coming off a little bit. This rally may be a little too much. Basic materials look like they're smoking hot right now. They don't look like they've got anywhere to go till the mid-80s. Healthcare, same thing. I like healthcare right now. I'm actually kind of bullish on healthcare. Basic materials and healthcare, two sectors I'm bullish on right now. Technology is looking pretty solid. Communication services is looking solid. Industrial is looking solid. Financial is looking solid. Consumer discretionary is looking solid. Real estate can go either way. Consumer staples is starting to make that comeback. Remember I told you it was a good time to buy here? Speaking of which, consumer staples sold off. And look at how we took advantage of it last week. This week, not last week, this week. Here's a few trades. CPB, consumer staples, right? Let's take a look. What's going on here? Let's look at my sheet here. We got in, let me just change this focus here. Let me show you this. We got in on the 23rd, which was right here, right there, right when it passed the 50-day moving average, right? And we got out 2 days later, right here. Not bad, right? That's the first trade this week. 2 days, 22.58%. Next trade this week, that was for Precision Profits VIP room. Then we had another one we got in right here on the 23rd, right here, and we got out right there. 2 days, and we made 20.15%. Then we took our first pattern trade for our, that's our demo program that we're going to be releasing soon, Pattern Trader for the candlesticks, and we got in on the 24th, which was right here, and got out the very next day. Got out on, let's see here. No, 23rd. We got in on the 23rd right here, and we got out right on the 24th. We had it for 1 day, just 11%. Didn't give us much upside. Then that's not it. We had 5 CVTA. This one, let me give them all to you. I got to show off a little bit today. CTVA. For overdrive profits, we got in this one on the 23rd too, which was right here, right there. I like this stock, and we got out right there. 2 days later, or actually 4 days later, we got in on the 19th. Sorry, we got in on the 19th on this one, right here, and we got out right there, and we made 20.51%. And last but not least, Coca-Cola and other consumer staple stocks for overdrive profits. We got in on the 19th, right here, right at the low, when everybody thought it was going to be cooling off. And we got out on 23rd, right here, right there. Look at that, continued moving higher. We made almost 30% on it, 29% in 4 days. So we took profits on, we got in and out on Campbell Soup, APA, PEG, CTVA, and Coca-Cola, and made double-digit profits on all except one. Not bad, right? Now, folks, volatility is not going anywhere. It's just gearing up. And I want to talk to you about something important. Actually, let me change the topic for a second. You guys want to hear something funny? I build a trading strategy with the premise to rip in a bull market, right? And it's completely proved me wrong in the sense that it works just as good, or if not better, in a crashing market like the kind we've been having. The conclusion is it's all thanks to one basic indicator that I'm guessing most people don't even know about. But it's been alerting the upside and downside potential in this market. That's because instead of trying to guess the peaks in stocks, we're going in when things are out of whack and then closing the position when it normalizes. Simple, clean, and easy. Click the link below and learn why now is the perfect time for this strategy. Can't make it for this class this week? I'm hosting another laid-back session Sunday, 10 a.m. Eastern Time, for all our veterans out there. I'll show you why this basic indicator is all we need right now. Click the link for the event. Isn't ready just yet, but I'll make sure to look and get you in on the upcoming one that's happening on Sunday. So you can either sign up and watch the one now or sign up for the one that I'm doing live on Sunday. Follow the link below. Check it out. You don't want to miss out. And if you can't find the link, go to the YouTube Wealth Press channel. It's there. Comments, feedback below. Put some comments in the YouTube videos. I want to hear from you. I want to know if you're getting in on any of these trades and if I'm helping you navigate this market the right way. Good, bad, ugly. Send me an email, support@marketgeeks.com, and have a wonderful, healthy, happy, and a relaxing weekend. And I'll see you Sunday at 10 a.m. live. That's how committed I am to your success. Bye.